In this video, we'll look at the best and biggest BlackRock iShares ETFs and how to choose the best ETFs for your goals. Whether you want capital growth, whether you want some dividend income or anything else, there's an ETF for everything. So we'll go over all of these and how to choose the best ETFs for you. I'll leave timestamps for this video down in the description as well if you need to skip around. What we're really looking for here is the best ETFs for our specific investment goals, and everyone's investment goals are different depending on your age and what you want. So if you're looking for a retirement fund, maybe you're not going to take the money out for 25 years, well, you're probably looking at capital growth ETFs because you don't need the money right now. Now, if you're much older, maybe you're looking to put the money into some dividend ETFs so that you get paid dividends regularly. If you're looking to invest only in the US or only outside of the US or in specific industries, all of that is possible with ETFs. So we can just choose the ETF for what we want to do. So if you're brand new to ETFs and exactly what they are, let's go through the basics. There are broadly only a few asset classes that we can invest in. So equities, these are stocks in the best companies that are publicly listed. Fixed income, which is government and corporate bonds, these typically yield lower amounts, but they pay interest over a certain period of time. So you have real estate as well that you can invest in, again, which is different. So you may find that the capital growth on real estate typically isn't as much as equities, but you may get a yield from the rents that are paid for the the real estate trusts. Commodities and digital assets, so you can buy an ETF that holds gold or Bitcoin, just gives you price exposure to those assets very easily. And then multi-asset, where the fund holds various different asset classes together. So we can invest in those, and you can decide what type of assets that you want to hold firstly, and then you just go and find the ETF for what you want to do. Now, again, the investment style of ETFs broadly fits into two categories. Active fund management, which is where you'll have people actively trading and managing the fund for some outcome that they want. So maybe they say, look, we want to have an index or a fund that achieves good capital growth, but also pays some dividend yields. And we're going to trade different assets and stocks and bonds and equities, and we're going to try to give you capital growth with some equity yield. So they're going to actively manage that. You'll find that the fees for the fund are much higher here, rather than the passively managed funds, which simply track something else and say, this is what we're going to track. We don't actively manage. We don't do anything. We're just going to track this and that's it. You'll see that the fees that you have to pay for passive funds are much lower than active funds. The vast majority of ETFs that we're going to buy will track indexes. The most popular fund right here on iShares is the S&P 500 ETF. The S&P 500 is an index. It is the 500 leading companies in the US. And so when you buy this fund, what you'll be doing is tracking those 500 companies. And there are a set of rules that dictate what those 500 companies are. Over time, the index rebalances to chuck out companies that haven't met the rules and to encourage other companies in that have met the rules and so on. And you can see that this is the non-US index here. This is an emerging markets index. So there are certain rules that dictate these funds, and this is how it works. You get an indexer at the top. Most of the time it will be the S&P, which is a company, it's an indexation company. They just set up rules of the road and say, this is what we're going to follow and this is why. And this is our index that we track. Another popular one is MSCI. So that's step one. They create an index. For example, they create something like the S&P 500 index. That index is just on paper, right? It's not anything real. It's just a set of rules. Now, what iShares do, step three, is actually track that index. They go out into the market physically and buy the companies in the S&P 500 at exactly the same rate as what the index is saying. So if the index is saying, these are the rules of the road, the company has to be a listed company, it has to be public, it has to be traded on an exchange in the US, because it's a US company, it's a US index, right, the S&P 500, and it has to have certain characteristics. iShares, BlackRock, go out physically and put all of those shares into their ownership for you to buy. So they create the fund, the ETF right here, and it tracks the index. And then, of course, they offer it, the ETF, for us to buy. And we go to our broker, Robinhood, Interactive Brokers, Schwab, whatever you use in your country, you will be able to go to your broker, search for these ETFs, and these ETFs will track something. So the S&P 500 ETF, and as you can see, everything else. So you have the total stock market ETF. These are just indexes. These are certain rules. Now, when you click into one of these assets, it will tell you exactly what the rules of the ETF are. So this one right here, the S&P 500, it seeks to track the S&P 500 index. As we know, the S&P 500 index is made by the S&P company, right? And it has certain rules, and it provides exposure to large cap US companies. Now, if you want to know specifically what the index is, you can go to the index company and they will tell you exactly the rules of the road as to what is this index tracking. But iShares, what they're going to do is physically replicate those indexes so that we can invest in them and gain exposure to the price movements. Let's go back to choosing the best ETFs for our specific investment goals. This is a matrix of the investable asset classes, and these are all going to be tracked by the iShares ETFs from BlackRock. So I'll get myself out the way here. Maybe you can screenshot the video or pause it, and you can see what these asset classes have returned over the last 15 years or so. So broadly, we've got equities versus commodities versus bonds versus real estate. So let's look at the NASDAQ 100 index right here. That's an index that we can now buy at BlackRock. They've just created a NASDAQ index as well. So that has annualized over the last 15 years, annualized at around 20% a year. So brilliant, 20% a year. But there's a lot of volatility because it's an equity index. So some years it might be down 15, 20%. Sometimes it might be up 20, 25%. You can see the returns here. There are certain years where you've had losses. Certainly in 2022, you've had a big 32% loss that you sat on. And then it obviously had good performance here. So there's more volatility here. So let's go down to, for example, the S&P 500, which is a broader equity index. So more companies, and it's annualized at around 14%. Let's go to investment grade bonds right here, which have annualized at around 3.7%. Something like Bitcoin, obviously annualized at 100%, but insane volatility there. So you've got three indexes here that you can buy at BlackRock. Two equity indexes. The NASDAQ 100 is 100 companies, mostly tech focused. It's more volatile, but has returned more over the last 15 years. The S&P 500 is more diversified. You've not just got tech companies, you've got a broad exposure to the US market. That's returned 15%. So a little bit less with some less volatility. For example, in 2022, you can see that the NASDAQ fell 32%, which is a big loss to be sitting on for that year, right? So you definitely don't want to be selling when the price is down. And then the S&P 500 that year only fell 18%. So because you've got a broader selection of companies and you've got some value companies in here and everything like that, it goes down less. But of course, over time, the NASDAQ with that higher volatility has actually returned more. And then you've got the bond indexes here, 3.7%. Now bonds are much more reliable in terms of what you're going to get back. So if you buy a bond and then you just wait till the bond expires and pays back, you know exactly how much money you're getting back. You're getting an interest rate, plus you get your money back that you paid for the bond. So more certainty, less returns over time. But you can see that bonds also can be pretty volatile as well. So you have to figure out what exactly is the best for you. If you're a young person, young people tend to invest more in equities. They tend to be more volatile, but they tend to return more over time. And if you're a very old person and you're not looking for volatility, you need certainty of income. Maybe you're looking more for dividend stocks or even for bonds because you just want to know what that return is going to be for you. Again, everyone's different, so you can just go and choose, what do I want? What asset class do I want to invest in? What am I happy in terms of the return profile and the potential volatility? Trust me, if you buy something, you'll probably sit on a loss on that thing for some point, right? If you're buying equities, you're buying the stock market, there'll be a point where whatever you bought, it will just sit underwater for a bit. But look, the long term is that usually stock indexes go up. So you have to figure out your age, how much volatility you can handle, what type of returns that you want. And then you can just choose the ETFs from BlackRock. I'll show you exactly how to navigate the ETF pages on the iShares website so you can know what everything means and how to figure out what you want to buy. But firstly, we have to talk about where you live and the tax implications of buying ETFs. The US is the world's capital market, and so there is a almost certainty that you'll be buying funds or stocks that are listed in the US. And it really matters where you live. Now, if you're inside the US, it's pretty simple. You're going to be buying probably US equities and ETFs, and that's fine. And you know within your state or wherever you live what your tax regime is. If you live outside of the US, this is where it starts to get complicated. So the US has very stringent taxation rules about non-US citizens buying US assets, known as US property. Now, if you're buying an ETF and that ETF is domiciled in or registered in the US, that is what's known as US property. and it falls under the tax regimes, two things affect you. Dividend withholding tax. So if you buy an ETF, which is US property, and it pays you dividend yields, which a lot of these ETFs will be doing. For example, the S&P 500 companies, a lot of them pay dividends in cash. That will be paid out to you. If you don't live in the US, then the US will take a withholding tax on those dividends, which is a flat 30%. Right? So for every $100 that you get paid in dividends, the US withholds 30%, $30. You only get $70. That is withheld at source, so that's taken away from you straight up. So you only get 70% of what the companies pay. Now, the other tax, if you are a non-US citizen, you don't live in the US, and you hold US property, which the ETFs would be, you also have to face the US estate tax or the inheritance tax if you pass away on your estate. Now, you get a tax exemption for anything under 60,000. Anything above that, Uncle Sam will take 40%, taxed up to 40%. Now, I presume that's on capital gains, but it could be on the whole thing as well. This must be avoided, right? Obviously. So we can't get into this if we're not a US citizen. We really need to make sure that we avoid these taxes. Now, luckily, there is a way to do this. The first way is to live in a country that has a double taxation agreement with the US, for example, the UK. So in the UK, you have a double taxation agreement. This means that the withholding tax of 30% is cut in half, and potentially if you hold those assets in something like a SIP, self-invested personal pension, they're reduced to 0%. That's part of the double taxation agreement. Now, the issue here is, even if you're owning these US funds, is that what you'll have to do firstly is actually pay the withholding tax. That will be taken. Then at the end of the tax year, you have to go to HMRC and you have to apply for a rebate. So that is a nightmare from a perspective of doing paperwork and everything else, right? It can get really complicated. That's an issue, right? It's just like, okay, you don't have to pay the 30, but it's just a lot of work. With the US inheritance tax in the UK, because there's a double taxation agreement, the inheritance tax will go to the American tax exemption, which I think is $15 million. So if you're in the UK, the inheritance tax rule won't affect you unless your estate is over 15 million. And the withholding tax will be reduced to 15%, but there's a big issue with paperwork every year. It's an annoying thing. That's an issue. Now, if you live in a country that doesn't have a double taxation agreement, you're in trouble because you're going to be paying 30% withholding tax and also 40% inheritance tax on your estate, which is massive. So there's a way around this, and it's called UCITS, which is a piece of Euro legislation which essentially reduces or takes away these US-based taxes. And the way that they get around this is that these funds that track the exact same thing, for example, the S&P 500, instead of being registered and domiciled in the US, they're registered and domiciled in Ireland, mostly Ireland. There are some other funds that would be registered in Switzerland, maybe in the Netherlands as well, maybe in Germany, but the vast majority are registered in Ireland. These are known as UCITS funds. They're exactly the same thing, but they're registered in Ireland. And this takes away the inheritance tax aspect because technically these funds will now be Ireland domiciled, which means you're under the Ireland laws. Now, the Ireland funds still pay a reduced withholding tax of 15%, but they pay it at the fund level, which means that if you're a UK citizen, you can own this fund, pay the 15%, and then not have to do the rebate thing at the end of the tax year, which is a much better option because you just don't have to worry about it. So 15% withholding, you don't have to figure out getting a rebate at the end of the year. So it's going to cut down a lot of hassle. The other thing with the inheritance tax is there's no inheritance tax at all. It's an Ireland domiciled fund. It's Irish property. There's no inheritance tax that you're going to be paying. So if you live outside of the US, for the most part, it is going to be beneficial for you to buy UCITS registered ETFs and not the US domiciled ETFs. Really easy to figure this out. If you're in Europe or the UK, you'll be offered the UCITS ETFs for the most part anyway. They're different funds, but they track exactly the same thing. You don't have to live in the UK or Europe to benefit from UCITS funds. These are available worldwide and anyone can own them. So if you live outside of those regions, then you can still own the UCITS funds and you still benefit from the tax advantages. If you're a non-US citizen, it is usually advised that people would buy the UCITS funds because even if you're in a country that has a double taxation agreement and you think everything is fine and you're not going to, be subject to any of that, maybe you move country to a country that doesn't have a double taxation agreement, right? And so you're then going to be liable for those taxes. And how do you switch out of the funds? Are you going to sell all of the funds and then switch into UCITS? That's a nightmare in the future. So deciding this is really important. Basically, if you're outside of the US, for the most part, for the current and future potential liabilities, it's going to be better to go for UCITS funds. UCITS funds are the exact same thing, but they're completely different assets. You trade them differently. So I'll show you an example here. In the US, and this is the US iShares website, you can see that the number one ETF is the S&P 500 ETF. It's got the most assets under management, so $888 billion right here. And the fund is called the iShares Core S&P 500 ETF. And the way that we find the ETF in our brokerage is by putting the ticker in, which is IVV. Great. Let's go over to the England website, the UK website. Looks the same, but this is iShares UK. Now, the UK aspect is that this is how they run their UCITS ETFs. You'll notice that on the iShares website in the UK, we have a lot of Japan government bond funds at the top here with assets under management. It's only down here that we find the S&P 500 ETF. Exactly the same index, which is a different fund registered in Ireland. Notice that the ticker is different, CSPX as well, and it has different assets under management. It's a completely different fund, even though it tracks the same thing. Now, you don't have to live in the UK to buy this fund. You can live outside of the UK, maybe in Hong Kong or the UAE or something like that, and you can still gain access to this fund that's going to be more beneficial for you. That's the two different types of funds, right? Within the US and outside of the US. So just make sure that you're looking at the assets that are going to be best for you to buy and hold over the long term. Now let's look at an ETF prospectus page. And to be honest, the name of the ETF is going to tell you what it does, but then you can drill down into how much has it returned over 5 or 10 years, how much of that is capital growth versus dividends, or if you're buying a bond fund, how much does it pay over time? So you can just click into any of these funds and see exactly what's going on. You can see that there is an expense ratio here. That is how much you have to pay for the ETF. So iShares is a company, they're providing this, they're going to have to charge some fee to make money, obviously. And so the net expense ratio is how much you own. That is how much you're going to pay out of the fund each year of your money to pay for owning the ETF. So 0.03 is very, very low. What I would do is, if you're looking at an iShares ETF, then you can compare it to another provider, for example, from Vanguard or one of the other providers. There are many providers out there. You don't have to be loyal to iShares versus Vanguard or someone else. Whoever is providing you the ETF with the lowest fees, especially for these big ETFs, that's going to be the best for you. Low fees is really important. They start to eat up your returns over time. But for the biggest ETFs, S&P 500, NASDAQ, they're all going to be the same because they're all competing very, very viciously for the capital to get into their fund versus the others. So the big providers are going to, will be virtually the same in terms of the total expense ratio. You can see the assets under management. So the S&P 500 is by far the most popular. So let's go into the S&P 500 page and we can see exactly what's happening here. So you can see exactly what the ETF tracks and what it's supposed to do. This is tracking the S&P 500 index. This is 500 best shares, best companies in the US. It's going to give you broadly capital growth with some dividend yield. How much? Well, you can see on the left-hand side. Don't worry about the NAV, that's the net asset value. For these funds, the NAV is going to be the value of what's actually in the fund itself, right? So the net asset value of the stocks that are held. And the price of the fund is going to track NAV 1 for 1 for the most part. Now, in some other types of funds, that doesn't happen. For example, closed-ended funds, you might find the shares of the fund actually trade at a premium or a discount to what's held in the fund, the actual asset value of that. That's a little bit strange, and we won't get into that for this video. But for these big funds, the shares are going to track what they actually own almost 1 for 1 at all times. You can see the yield of the fund. Now, because this is a stock fund, this yield is a dividend yield. So these are cash dividends paid out. You can see the 12-month trading yield is 1%, and then that's over the last 12 months, right? So if you held the fund for 12 months, you'd get paid 1% of what you owned in cash. So if you held $100 of the fund, you get paid $1. Now, the 30-day yield is slightly lower than that. What does that mean? Well, the yield is just simply the price of the shares and in comparison to how much you get paid in cash versus the price, right? So what this means is that the yield over the last 30 days is slightly lower than it has been over the last 12 months. This suggests to me that either companies are paying less cash or potentially they're paying the same amount of cash, but the price of the shares has risen quite quickly. You can get these distortions because the fund pays quarterly. You can see that here, distribution frequency. That is how they pay the cash to you, once per quarter, so 4 times a year. So obviously the price is going to move. If the price moves up quickly and there's no dividend for a few months, then you can see the yield, the dividend yield can change a little bit. But we're looking at around 1% yield or so not exactly a lot in terms of cash yield. But the most gains from this fund will come from capital gains then. Hopefully we make gains, right? You don't want to make losses here. And as we come down, you can see the characteristics of the fund, and this is going to change. So the number of holdings, the S&P 500, it's about 500 companies. Now, what companies are owned? You can see that down here. So it's the largest companies in the US, Nvidia, Apple. So what you do when you buy the fund is you're getting an exposure in percent of all of these companies. If you put $100 in, we can go to the right-hand side here. $7 is going to Nvidia, $7 is going to Microsoft, Apple and Microsoft, 4% to Microsoft, 3% to Amazon, and so on. $3 to Amazon, and it just goes down the list. Now, what will happen over time is that the fund will rebalance and buy and sell certain amounts of shares dependent on their market cap. That's how this index works, and BlackRock are going to follow the index. What we can do also is go to the fact sheet right here, and that looks like this. And it can show you what a hypothetical $10,000 since inception has gained. That's fine, but what happened over 5 or 10 years? You can go back to the prospectus page, come down here, and you can search by the cumulative or average annual. I would say average annual. That gives you a decent figure of what we're expected to grow over the long term. So sometimes it might be up 20%, down 8%, something like that over each year. Average annual over 10 years is around 15% return. So a really good return for the S&P. But as we come into the prospectus page again, equity index, right? So just broad equity exposure. It's paying quarterly dividends, so you'll get 4 dividends a year. You see the management fee, other expenses, 0. And the benchmark versus what its performance is. So you can see that the benchmark is being tracked literally 1 for 1, right? There's no difference between what the benchmark is, which is the S&P index, and what this fund is actually doing in the real world. iShares denotes their very broad indexes. They're very vanilla products with the name core. This just means that this is what most people are using as the bulk or the basis of their portfolio. There's nothing too crazy here, right? S&P 500, it's just the index, right? It's what everyone agrees is the index. That's it. So core S&P, core MSCI, this is an international index, I think non-US in Canada, right? So it's a core position, it's a large fund, it's liquid, lots of people own this as the bulk of their portfolio. You can see core mid cap, core small cap. So what should we put in our portfolio? Well, that's up to you, exactly what you want. So what we're gonna do is just go through the typical types of ETFs that you'll see, not just from iShares, but from others as well. Core or popular, broad indexes. You're not taking, too crazy risks here or anything else. A lot of people own them, and it's the basis of most portfolios because it's broad and vanilla. Now, you can get more specific. For example, iShares value indexes. There's a value index here. I think it's the S&P 500 value. And this is obviously more specific for a theme or some sort of outcome that you want. What does this mean? You can see here, Russell value. So you're investing more in value stocks. Well, what exactly is a value stock? Well, as I said, everything's an index and it will tell you exactly what they're trying to track. So this will be undervalued from some metric. There'll probably be a price to book ratio or price to earnings ratio that is low in comparison to other market participants. And they will go towards those rather than other types of companies. Now you have growth ETFs as well. Well, what's a growth ETF? That will be companies that have above average profits or profit growth or revenue growth versus the other companies. And so you'll go more towards them. Now you may think, well, I want growth, so I'll just invest in growth versus anything else. Maybe not. So this is core S&P 500, S&P 500 value, and S&P 500 growth. You can see the 10-year returns, annualized returns on them. So the growth fund has only outperformed the normal S&P by 1% a year, even though it's a growth fund. Why is that? You'll notice that with more specific funds, they tend to trade more often, and then the fees are higher. So with a growth fund, you now have to more actively manage this fund to search for companies that have those characteristics. However, those characteristics over a 10-year period probably aren't going to last. So certain companies that are making very high profits now or growing revenue now, you're going to have to go into them. But maybe 3 or 4 years later, that growth stalls and falls away. And you're still going to own those companies as the share prices fall. Now you're going to have to trade out of those companies because they don't meet the index rules, and you're going to have to trade into other companies which are starting to go higher as well. And the active or more over trading that happens can lead to underperformance because you're timing the market a little bit more, and maybe the fund is trading the shares not at the best time. So even though you've gone into a growth ETF, you've hardly outperformed just buying the S&P anyway, because those shares are probably going to be in the S&P fund anyway, and you're not over trading them and getting in and out and everything, and you get most of the value. You get most of the value of the growth, right? Now the S&P value index has only grown 11% of year, and that's because simply you've got lower priced assets, right? Now the reason a stock would be valued quite low in relation to its price to book or its revenue or anything else is because the market doesn't think that it can grow those things quickly in the future. Therefore, the valuation in relation to the profits that are made starts to come down because the market isn't valuing potential growth into the future. And so, yes, value is not going to perform as well as companies that are growing. Like companies that are growing are valued quite highly in relation to their current profits because the market is forward thinking over the next 5 or 10 years, their revenue and profits is going to grow. So we're going to give them a higher valuation. So if you're going into value, the reason those stocks are valued lowly in relation to their profits is because the market doesn't think they're going to grow. And the market has been correct in those because the growth is only 11 versus 13 or 14. So the market was correct. They didn't grow, right? That's the thing. You're constantly having to go into companies that are undervalued, over switching as well. So that's an issue. Now, the other thing to figure out isn't just returns, but also the volatility of returns. If you go into a growth fund, you're going to have higher volatility potential. Now, that is higher volatility because it's growing more. It's got 14% versus 11, for example. And with higher volatility and growth, you also get potential downside volatility as well. Now with value tends to be less volatile, so less upside, but also potentially less downside. By the time you've figured out, I want some growth and some value, just go into the S&P, make it simple, right? It has some growth and some value. That's why you see the core denomination on the S&P 500, right? Now you might see core value and growth as well, denoting that it's a fund that is popular and most people will use. But just because you want growth, the growth fund may not be the best. Right? If you want less volatility or value, that doesn't mean that you're going to get extra growth because those assets are valued cheaply in relation to their profits now. There's a reason for that potentially. So it's just usually the best to just go with the index, and over time you're going to get broadly similar results. There's only 2 things to figure out when making any investment really. So the first one is time horizon. If you've got 25 years until you retire and you're putting money into your fund that you're not going to take out for 25 years, then you can afford way more volatility. You don't care if you sit on a 20% loss 1 year, right? You want the thing with the most growth, and that tends to be equities. They tend to outperform over time. Now, if you need the money next month, buying equities is not a great idea. You may be sitting on a 3% loss. So you're going to go towards a money market fund, which iShares have, which is they take your money, they put it in a very short-term government bond fund. And so you put $100 in, you're going to get $100 out plus a tiny bit of interest. Less returns, but more certainty. That's the first thing. The second thing is, what do you actually need, right? So you need to look at the total return of each index over time and what you think it will be broadly over the time that you hold the fund. So let's say you want to hold a fund for 10 years. Do you want the most returns, or do you want maybe more cash returned to you? So for example, a high dividend fund. Everyone loves getting cash in their account, seeing that dividend hit their account, that cash, it just feels so good. Dividend funds tend to underperform the normal index. Let's take the S&P 500 as the index. It's returned 13% per year over the last 10 years with volatility. High dividend funds pay more cash, right? But you tend to find that companies that pay high cash dividends don't have as much capital growth in their shares versus other companies. So for a dividend fund, you're looking at a yield of around 3% a year. which is 3 times the S&P fund. But if we come down, you'll see that the companies here are much more boring, they have much less growth. The share prices aren't going to grow as much as the S&P because the S&P holds more Nvidia, Tesla, Meta. These have revenue, earnings, growth, right? And so the shares can grow a lot more than these. These are much more boring. They pay higher dividends, but you'll notice that over time, the S&P fund, as the index, returns 13% a year over the last 10 years. This fund has only returned 9%. If you don't need the cash for 10 years, then why do you want being paid that cash? You're going to be better going into the S&P and outperforming it by 4% a year. Over a 10-year period, that compounds to be a huge amount. And then in 10 years, if you want the money, you can take it out. And you've got the money there and the returns over and above what the cash was paid to you. Now, if you're older, maybe you don't want that and you want more certainty in the cash that you're getting paid because maybe you're nearing retirement, your earnings are starting to come down and you're looking when you retire, you're not going to be making any earnings. And so you just want higher dividends. And so you're going to go into something like this versus the S&P because you just don't want the volatility. You know you've got some buffer here. So it's about the dividends that you want, if you want any, plus the capital portion. So over the time period that you want to invest, what do you need actually? And what do you want to go into? Do you want to go into more capital growth or more dividends? Figure out what the total return will be over that time, plus the volatility, because it's all volatile. In 9 years' time, you could have made great gains and there's a stock market crash. Well, that's going to affect the dividend yield funds as well, right? So figure out what volatility you want, and then you can figure out, do I want a dividend ETF? Do I want a growth ETF? Do you want to go to specific into something like gold or Bitcoin or anything else? And that's how you build your portfolio. When buying and selling the fund specifically, all we have to do is go to the iShares website, find the fund you want, find the ticket of the fund, which is 3 to 5 letters. Right here, you can see it underneath each fund. Then just go to your brokerage app. If you're in the US, mostly these are listed on the New York Stock Exchange, exchange traded funds. Any broker is going to list these for you to buy. If you're outside of the US, the UCITS funds are traded on other exchanges like London Stock Exchange, Swiss Exchange, Hong Kong maybe, and they'll be listed in different currencies as well. Pounds, euros, US dollars, Japanese yen, and some others. So figure out what specifically is the fund that you want to buy and where it's listed and the currency. Then go to your brokerage app and just find the fund. You can see I've got an iShares S&P fund here. Now, what I also have to figure out is, do I want a distributing fund or an accumulating fund? Distributing funds pay any dividends out to you. They distribute the dividends to you. So they pay tax at the fund level. And then if you get a dividend, well, you're going to have to figure out if that's taxable where you are as well. So if you have income tax where you are, you may have to declare that and pay at your prevailing rate. Accumulating funds only pay tax at the fund level, and the dividends that they get are automatically reinvested back into the fund. So they don't pay out to you, therefore you won't have any income tax liability on that. So you can figure out distributing or accumulating funds, figure out the currency that they trade in, where they trade, and all of the other tax implications and regulatory implications as well, wherever you live. I'll leave some other helpful videos on investing and ETFs down in the description below, and some deposit and training bonuses to the exchanges I use will be down in the description as well. I'm James, this is Money's G. Cheers for watching, and I'll see you in the next one.